You ever look at a chart and feel like something's missing? Like there's a void, a gap, not in price but in logic? You're not crazy. You're seeing what the smart money left behind. You're staring at a fair value gap. But before we unpack this golden concept, let's be real for a second. Most traders chase price. They follow indicators like sheep. MACD crosses here, RSI oversold there, and still, boom, stop loss. Candle wicks slap them in the face again and again. Why? Because they're trading where the noise is, not where the imbalance lives, not where institutions enter, not where the market screams, hey, this area wasn't treated fairly, price needs to come back. Welcome to the world of fair value gaps, where logic meets liquidity, and imbalance becomes opportunity. So what is a fair value gap? Let's break it down from the core. In the simplest terms, a fair value gap, FVG, is a price imbalance caused by aggressive buying or selling, where the market skips through levels too fast, leaving a vacuum that price often returns to later. This isn't some fantasy or cherry-picked theory. It's baked into the DNA of how institutions execute large orders. Picture this. You're watching a 3-candle sequence on a 15-minute chart. Candle 1, slow, nothing much. Candle 2, boom, huge green candle. It shoots up aggressively. Candle 3 opens higher, never touches the previous candle's wick, then continues. What just happened? That second candle created a fair value gap between the high of candle 1 and the low of candle 3. Let me say that again. The fair value gap is the range between the wick of candle 1 and the wick of candle 3. That entire price zone was skipped. No trades, no liquidity, just a fast move. Why does the market come back? Think like a big bank for a second. They can't just throw in $1 billion buy order at once. They have to split it, layer it, hide it. When they push price up aggressively, it creates an imbalance, an area where not enough orders were filled. They need price to return so they can finish the job. That return is your sniper entry. That fair value gap is your battlefield. What's the logic behind it? We call it a gap because it represents a lack of trading activity, a spot where market efficiency broke down. Think of it like this. The market is supposed to be fair, right? Buyers and sellers should meet at each level. But during aggressive moves, someone gets left behind. And institutions, they don't like unfair trades. They fix it by bringing price back. And this retracement is where you enter with conviction. Because now you're not just chasing price, you're waiting for it to rebalance. Bullish fair value gap example. All right, let's say price is trending up. Suddenly one big green candle rockets. You spot a gap between the wick of candle 1 and candle 3. You mark that zone. Wait, price climbs a little more, then stalls. It finally retraces, down into the gap. Right there, in that zone, boom, bullish entry. Why? Because price is filling the imbalance. Big money is likely re-entering. They never finished buying. Now you jump in with them. Set your stop just below the gap. Your TP, the recent high, or the next liquidity pool. Clean, smart, tactical. Now take a deep breath and look at this chart. Right in the middle of this movement, there's a powerful story playing out. A fair value gap has been left wide open. You see that aggressive move down between these two candles. The market didn't just fall. It ripped through price levels without a moment's hesitation. That's your first clue. Look closely at the 3 candles forming that move. There's a clean imbalance between the first and third candle. The price never came back to trade within that zone. That is the fair value gap, that gray box you see highlighted. It's the footprint of inefficiency, where no buyer or seller got a chance to react properly, because the big boys, institutions, smart money, wanted in or out fast. They broke structure, created the imbalance, and kept moving. But here's where it gets powerful. Notice what happens next. Price eventually returns to that exact area. Why? Because that's the magnet. That's the zone that needs to be balanced. Liquidity lives there. Orders that never got filled on the way down now become key points of interest. Price taps into the FVG, respects it beautifully, and then shoots up again. If the market leaves behind a gap, it will most likely come back to fill it. And when it does, that's your window. That's your sniper entry. Don't underestimate it. So how do you actually spot these gaps? Here's how to spot them easily. 1. Use a 3-candle structure. 2. Look for fast movements, impulsive candles. 3. Identify gaps between candle 1's wick and candle 3's wick. 4. Mark that zone. 5. Wait for price to revisit it. 6. Use confluence like order blocks, divergence, or volume spikes for confirmation. Fair value gaps aren't magic zones. They're smart money footprints. Used with precision, they become your entry blueprint. But used blindly, they become traps. So you wait for confirmation. You wait for price to enter the gap. You read the candle language. You execute with patience. Now, open up TradingView, draw a few FVGs, backtest them, see the magic happen. If this made you see price differently, smash that like, subscribe, and drop FVG Master in the comment.